Hello, welcome to the Plain Bagel. We are back with another question and answer video. I'm joined as always by Craig the cameraman. Craig, say hi.
Hello.
Before we hop into the first question, just want to say a quick thank you. The channel's done really well. We hit over 30,000 subscribers, which is unbelievable. At the 1 year mark, I said I was happy at 2,000 subscribers, and we're at 30,000 now, so that's incredible. I also wanted to thank everyone for the amount of enthusiasm behind the Bagel Buddies pilot episode, I guess. Unfortunately, a lot of pushback from the network. I'm really fighting for the series, guys, but it's not looking so good. We might have to stick with investing videos for now, but nonetheless, I really appreciate the love and the amount of enthusiasm people had for that video. It's great. So with the question and answer videos, we take an opportunity to address questions in the comments section, and it's a bit more casual. Craig and I just kind of list off questions, and yeah. I keep trying to describe what a Q&A video is, but I think that's pretty self-explanatory. If you have any questions that you want me to answer in a future video, leave a comment down below and we'll do our best to get to them. But with that said, let's get on with the video.
Connor Lindahl asks, can you talk about T-bills?
Sure. So T-bill stands for Treasury bill. And it's essentially a bond that you purchase directly from the government of the United States. The Treasury bill is simply the short-term version of the Treasury bond. So a bill will have a maturity that's under a year. Usually 3 months is a very common version of that. And yeah, it's basically considered one of the safest investments you can have, which is why when the stocks kind of experience some turmoil, a lot of people will go to Treasury bills and Treasury bonds and buy those. But naturally, because they're very low risk, in some cases considered risk-free, they also offer a very low return to investors.
Extreme Fighter asks, what is your opinion about technical analysis?
Oh, that's an intense name. By trade, I'm a value fundamental investor, and that means that I look at a company's management, their service, their product, and I try to ascertain whether it's a good business or not. Technical traders really only care about what the price of a stock has done. And it's the idea that it's this belief that stock prices follow patterns. They go up and down in a certain way, and that if you can recognize these patterns, you can profit from the position. You can basically forecast a part of the price movement. I don't argue that there are probably patterns in the market that exist, and that's because of things like money flows. And part of it is a self-fulfilling prophecy, right? If you have this whole group that believes that when a stock falls by 10%, it's a buy. I'm not saying that's a thing, but if that were a pattern, then when all those people buy after 10%, it will boost the stock price. It's a self-fulfilling prophecy in that regard. But I think a lot of technical trading is kind of hindsight. Like it has kind of a hindsight bias to it. Like you look back and you say, oh, well, of course this was a W pattern, when someone else might say, well, no, it was a V pattern, or, you know, like I think that's kind of what I struggle with. And, you know, there are people who make a lot of money with technical trading. That's fine. It's not something I subscribe to personally.
Hutman then asks, buy Bitcoin?
No.
Philippe Behrens asks, if dividends are double taxed, would share buybacks be better?
When a company pays a dividend, before it can pay that dividend, it has to pay taxes on its earnings. You know, any company that makes money has to pay taxes. And then when they pay out the dividend, you end up paying taxes because that dividend is a income of sorts. In some cases, it gets a preferential tax treatment, but you're still taxed. And that's what they mean by the double taxation. And to answer your question, share buybacks are beneficial depending on what you plan to do with the money. If you're an income investor and you want that dividend to hold on to buy stuff, or, you know, if you're in retirement or whatever, then the dividend might be a better option for you. But if you're going to take the dividend and reinvest it into the company, then I believe the buyback is more tax efficient, so there would be a benefit there. But again, it depends on what you're trying to do with your investments.
Christopher Robbins asks, I always hear people say rebalance your portfolio, but what are some practical tips for how and when to rebalance your investments?
For people who don't know what rebalancing is, it's a strategy you use with your portfolio of investments whereby you sell positions that have done well, not all of it, but a portion of the position that has done well, and buy a position more of a position that has done poorly to bring them closer to kind of an equal weight. And the idea is that by doing that, you re-diversify your portfolio, and you don't become too overweighted to one position or another. Because in a portfolio with two positions, if one does really well and one does really poorly, at that time point, the position that's done really well, you're now really overweighted in that position because it now represents more of your whole investment. In terms of strategies for actually rebalancing, one thing you can do is you can set target weights for your positions. So for example, if you have 10 positions in your portfolio, you could set your target weight for each position to say 10%. So each position is equally weighted. And then one approach is you can do calendar weighting, rebalancing, which means that once a month or once a quarter or once a year even, you go back to the portfolio, and if a position is above or below the 10%, you buy or sell to bring them back to 10%. The other approach is to do a percentage of portfolio strategy, where you immediately rebalance as soon as a position deviates by a certain amount from their target. So for example, if you let's say you set a 5% threshold. So if your position went above 15% and you had a target of 10%, then you would automatically sell and bring it down to the 10%. And then obviously you could do a combination of the two, where once a month or once a quarter you check, and if anything is above or below their threshold, then you do the rebalancing. There's a lot of different approaches. Obviously you don't want to be trading too often, because then you'll kind of accrue more expenses and more fees. But rebalancing is a way to mitigate the risk of your portfolio. So it's handy to have some sort of rebalancing one way or another. And that's all the questions we have. Thank you very much for watching. Like we mentioned at the beginning, if you have a question you want us to answer in a future video, make sure to leave a comment down below. We're getting a lot more than we used to, so if I don't get to your question in a video, I will try to address it in the comment section at the very least. But with that said, thank you for joining us, and we'll see you in the next one.